All right, let's talk Palantir, ticker PLTR. After a massive run, the stock's kind of at this really interesting turning point. So what we're going to do is break down where it stands right now, technically speaking, and then walk through a specific options play from our source material that's pretty much tailor-made for this kind of situation. Let's dive right in.
Okay, so first things first, let's get the lay of the land. The source material has a really interesting way of looking at Palantir's recent price action. They don't see it as some big collapse, but more of a corrective phase. And that makes sense, right? I mean, after the huge growth it's had, a little cool down isn't a huge surprise. But the real question is, what does that look like on the chart today?
So right now, the stock is hovering right around $145.89. Just keep that number in your head, because it's basically the starting line for the whole strategy we're about to unpack.
But here's what makes that number so important. That price, it comes after the stock has already dropped about 31% from its recent high. That's a pretty big deal. It tells you the momentum has totally shifted, and we're not just in that easy stocks only go up phase anymore.
Okay, so if it's not going straight up, what is it doing? Well, it's basically bouncing around. The source describes it perfectly. It's like it's stuck in a room, with a support floor holding it up and a resistance ceiling pushing it down. It's just stuck in this range, trying to figure out which way to break.
And just to be super clear on what that means, support is basically a price point where buyers tend to show up and say, nope, not going any lower, and start buying. For Palantir, that line in the sand is right around $128. Resistance, well, that's the opposite. It's a ceiling where sellers take over. So the big picture here is that Palantir is in this constant tug of war, but it has this really important safety net at 128.
Now, all this bouncing around, this volatility, it can make you a little nervous, for sure. But what's cool is that our source material actually lays out a way to use this uncertainty to your advantage. Let's get into what that plan actually looks like.
So yeah, that's the million-dollar question, right? How do you play this kind of market? Instead of just sitting on your hands and watching the ticker, the idea here is to get proactive, to use that choppiness, that higher volatility, to actually create some income.
The tool for the job here is something called a cash-secured put. Look, all that means is you're getting paid cash today for agreeing to maybe, just maybe, buy a stock you already like, but at a much lower price that you get to pick. It's like you're setting your own buy-it-on-sale price and getting paid to wait. It's a pretty sweet deal, really.
And I love how the source material puts it. They call this a sleep-at-night kind of play. And that's exactly the vibe. This isn't about making some wild, risky bet. It's about making a really smart, calculated move where you know exactly what you're getting into from day one. Okay, so enough of the high-level stuff. Let's get down to brass tacks. What are the actual details of this trade? What are the numbers we're talking about here?
So here's the blueprint. The play is to sell a put option that expires pretty soon. The strike price, that's the price you're agreeing to buy the stock at, is set at $120. Now, for making that promise, you get paid. You collect a premium that's estimated to be somewhere between $1.60 and $1.65 per share. And remember, one options contract equals 100 shares. So that means for every contract you sell, you're pocketing somewhere between $160 and $165 right up front. That cash is yours to keep no matter what happens next. That's your profit for making the deal.
Okay, this is where it gets really interesting. Getting paid is great, don't get me wrong. But the real magic behind a strategy like this is how the price was chosen. Why $120? What's so special about that number?
Right? I mean, why not 130 or 110? Well, picking 120 wasn't just pulling a number out of a hat. It was chosen very deliberately, based on three key things that all come together to create this really nice safety buffer.
So according to the source, there are three big reasons. First, it gives you a cushion for earnings. Second, it creates a really deep safety floor from where the stock is today. And third, that price level itself is a historically strong support zone. Let's dig into each of these. First up, the earnings cushion. So Palantir has earnings coming up, and you know how that goes. It's always a bit of a coin flip. But check this out. The source points out that even on a bad report, the stock might drop, say, 10 or 12%. For you to actually have to buy shares at 120, the stock needs to fall more than 15%. That's a pretty massive buffer against bad news.
Reason number two is what we're calling the safety floor. Think about it this way. By picking that 120 strike price, you're basically putting your foot down and saying, look, I'm only interested in buying this stock if it takes a nosedive and drops almost 18% from its current price. You're essentially demanding a huge discount before you're willing to step in.
And last but not least, there's the technical support. That $120 price isn't just a number plucked from thin air. That whole area from about 116 to 120 is what chart analysts call a high-volume node. All that really means is a ton of shares have changed hands right in that zone before. It's a huge signal that big players, the institutional buyers, see value there and have stepped in to buy before. It's like a concrete foundation for the stock price.
Okay, so let's wrap this all up. What's the main takeaway here? What's the one thing you should really remember from all this?
It's this. You're basically setting yourself up for one of two great outcomes. Outcome one, the stock stays above 120 bucks. If that happens, you just keep the cash you were paid up front. It's pure profit just for being willing to buy. Outcome two, the stock does drop, and you get to buy a company you already liked, but you get it at a major discount. So you either get paid to wait or you get to buy on sale. It's a win-win.
And when you really think about it, a strategy like this isn't just about Palantir. It makes you ask a really important question about all your investments. It's all about figuring out where your personal line in the sand is, what you're comfortable with, and then finding ways to build your strategy around that. So it really leaves you with one final question to chew on. What's the right balance between risk and reward in your own playbook?